Good morning, everyone. Hope you had a good start to your day. We've got about 120 people joining us for today's session, so I'm just going to take some time before we go into the intros. Just let everybody log in. Abi, how are you today?
I'm well, thank you. Yes.
Good, good. It's a bit gloomy and a bit grey, I think, where I am. So hopefully it's not quite like that where you are.
Well, I'm in the walkie-talkie, but I'm in an inner room, so I can't look out the window. But it's a nice view.
Perfect. Look, I can see that everybody's sort of logging in now, so we'll get started with no further ado. Good morning, everyone, and thank you for joining us. For those that you don't know me, I'm the MD of Fram Search, Simon Roderick, and I'm delighted to welcome you to today's session, the Boardroom under the Microscope, Governance Risks in Alternative Investments. I'm really pleased to be hosting this and to be joined by Abi Reilly, partner at Ocorian, as we explore how boards, investment committees, and asset managers can navigate today's increasingly complex governance landscape. Before we begin, just some quick housekeeping. The session is being recorded, and we'll share a copy of the recording with all attendees afterwards. We'll have time for Q&A at the end, so please do submit your questions in the Q&A box as we go. And your microphones and cameras are turned off to help keep the sound quality clear. And the session should last about 45 minutes, maybe it's an hour, but we will try and be very prompt. And if you have any technical issues, please message us in the chat, and we'll obviously do our best to help. Abi, before you start, would you mind just telling us a bit about you and your background and the work that you do at Ocorian?
Sure. Much to my horror, I realise that next year it will be 40 years in the city. Started at the stock exchange pre-Big Bang, and then this strange thing called TSA, as it was then, was born in 1988, and I've been in compliance in some form or other ever since. Bulk of my career was at UBS, whereas I'm a managing director, head of Europe, Middle East and Africa risk and compliance. And I moved into consulting in 2012 and have been at Ocorian, which was then called Beauville, since 2017. So in the last 8 years, I have headed up a team of now 20 people specialising in providing ongoing regulatory advice to asset managers of all descriptions, but probably with a bias towards the alternative sector, whether that be hedge funds, private equity, venture, real estate, infrastructure, full scope AFMs, small AFMs, advisor arrangers, etc. As I say, providing ongoing support, but also helping with particular projects around governance, conflicts of interest, financial crime. So those are the a sort of sweet spot for me, which is probably why I'm talking about them today.
And there's so much that's gone on in the last few years, I think. I mean, obviously, you've just explained you've had a long career in the city, and you've probably seen and done everything. But there's been so much change in the last few years. I'm really looking forward to the session. So, Abi, over to you to get us started.
Okay, thank you very much, Simon. So if I just have a quick look at what I'm intending to cover today. We have got a Q&A session, as Simon mentioned, at the end. But if you've got burning questions, you can put them in the Q&A chat, and I will try and make sure I get back to them. I'm going to start off with the regulatory context. Why is this important? What have we heard from the regulator recently? And then I'm going to talk about governance and oversight and the role of the board and committees. I'm using the word board here, but it's a sort of shorthand for your most senior governing body. For some of you, that will be your partners. Some of you, it will be a management committee. But I'm using the term board to cover all of those. I'm then going to sort of move into areas of risk, which we know the regulator is obsessed with, and where you need to have the appropriate approach from a risk perspective and from a governance perspective. So financial crime continues to be very important. And then I'm going to look at some other risks that ought to be assessed especially when making investment decisions. And another big focus for the regulator, we know, in the asset management space is conflict. So we'll be talking a little bit about that. So if I look at the regulatory context, so first of all, a quote from the Dear CEO letter from February of this year, addressed to asset managers and alternatives. Now we know the FCA are retiring these as a method of communication, but they still exist and are pertinent. So they are concerned that the increasing trend towards investment in private assets has that trend been met by commensurate risk management, especially to tackle financial crime risks, especially when you consider complex ownership structures, both in terms of investors but also investments. FCA said that firms should be alert to the risk that they could be used to facilitate financial crime, including fraud, money laundering, terrorist financing, bribery, corruption, proliferation finance, and that FCA called for firms to have appropriate and proportionate systems and controls to mitigate these risks, and that they should have robust due diligence on both investors and investments. Now, hot off the press, which I had to quickly add in at the last minute, was last week's focused supervisory intervention. So FCA has written to a significant number of asset managers and alternative firms, giving them till the end of December to respond to a 49-point questionnaire about their financial crime arrangements. And having looked at it, it's heavy going. First of all, to translate it, to try and understand, they mix up the term client, investor, structure quite liberally. So trying to navigate one's way through it to understand what they're actually asking for. But the clear expectations, it's a multiple choice questionnaire where A is clearly the answer that FCA would like. D, you're probably going to get a visit from the regulator if you answer D on any of these questions. So there are expectations are high around business-wide risk assessments, focusing on financial crime policies, procedures, oversight, control, monitoring, etc. If you haven't seen it, lucky you. But if you have, I think you will recognise that this is going to be quite a significant exercise. And clearly FCA are going to follow up post-questionnaire with visits and possibly enforcement. And there may be some need for remediation for firms. The other piece of regulatory context I'm going to give you is over a year ago. But if you haven't read this, it's a kind of good read, if there can be such a thing in terms of an enforcement notice. But it's instructive, and this is around H2O, asset management, LLP. And in fact, just recently we've had the enforcement notice against the individual deputy CEO who has been fined in excess of £1 million as an individual for showing lack of integrity. So one of the principal breaches. But at the heart of this case was the concern that asset managers conduct themselves appropriately, acting on behalf of their customers, and that they have a relationship of trust. And when they say customers here, they clearly also mean investors. And the criticisms, and there were many, were first of all that investment decisions were being made without any evidence of proper due diligence. And in fact, the gentleman who got fined made up due diligence meetings after the event, to misled FCA. So the due diligence was completely lacking in respect of a number of these private investments. And there was a significant conflict of interest because the CEO of these various private companies was the best friend of the CEO of H2O, and there were 50 examples of gifts and entertainments being provided to various members of the team, the investment team, including the use of private jets, yachts, and tickets to the Monaco Grand Prix, none of which had been properly cleared or registered. And so the finding clearly was that the firm didn't manage its conflicts, didn't conduct its affairs effectively. And there was considerable criticism for the compliance department, who seemed to be completely unaware of what was going on, and that no formal governance mechanism at all. So it's clearly a matter of great interest to FCA, this subject. I also happen to know that they are conducting, as they usually do, these high growth reviews on one of my clients, where they were authorised relatively recently and have grown very quickly. And almost the first question from FCA is, tell us about your board, your managing governing body, what is its terms of reference, who is its members, how often does it meet, where are the minutes? That's a sort of baseline question. So let's look at the role then of the board and committees under the board. So I'm actually not going to start with FCA. I'm actually going to start with the UK Corporate Governance Code that came in 2024, which basically says that boards need to carry out an annual review of the company's risk management and internal control framework, and actually from the 1st of January next year make an annual declaration as to the effectiveness of material internal controls. So the board has to own the systems and controls that it's implemented and comment on their effectiveness. There need to be formal and transparent policies and procedures to ensure the independence and effectiveness of the audit function, and indeed, if you haven't, because you're not of the requisite side, got an audit function, any control function such as compliance. And what the board should be doing is making a fair, balanced and understandable assessment of the firm's position and prospects with the requisite information needed to do that. Now, I've talked about committees, and we work at Ocorian with some very small funds who quite recently say to me, if I had all these committees, it would only be exactly the same people sitting on them who sit on the board. So really, is there a need? And I don't think there is a need, as long as the matters that these committees imply are covered properly and appropriately and documented, then I think you can do all this within the board. But as you get bigger, as you get more complicated, thinking about the use of separate committees to undertake certain functions. Now, I would imagine that most people on this call would have some kind of, whether it's audit, risk and compliance, or just risk and compliance committee that reports into the board. An investment committee is key, obviously. You can decide remuneration as part of your board, but quite a lot of firms have a separate remuneration committee, and importantly, a separate valuation committee with different constituent parts. Those are the sort of key ones. I also see people have committees for finance, strategy and transformation, people and culture, conduct, and conflicts. And interestingly, there was a case a few years ago against GAM in terms of not managing conflicts effectively. And one of the findings was they had a conflicts committee, they had a conflicts champion. No one knew who he was, and the conflicts committee had never met. So be careful what you wish for. It's all very well having beautifully crafted terms of reference and a desire to do this stuff. But if it's not real and you're not going to use these committees, then they are just a waste of time, and you should just do things via the board. So what are the role of these committees? Well, they are adjuncts to the board. So they are created to deal with very specific tasks for which, importantly, the board is responsible, but may not have requisite time or resource to manage. And they will meet according to their task as specified in their terms of reference. It may be at a specific time of the year coinciding with a compliance monitoring or audit cycle for that particular committee, or the finance committee might meet to approve the accounts, etc. The important thing, though, is that they make recommendations to the board, who always make the final decision and must do. And that's part of both corporate governance in the round, but also FCA's expectation that the board cannot say, oh, we didn't know about this, we delegated it to somebody else and they made the decision. So, and part of that, how that symbiosis between the committees and the board should work, is that the board must be provided with appropriate and effective management information. So if you are a board member or a senior manager and you have delegated certain activities to a committee and they are not reporting back on things like complaints, breaches, errors, conflicts, if you're not seeing the flow, evidence of investment due diligence, for example, KYC, then you need to call those committees to account. So moving now into the FCA, obviously there is CISC, which is the Senior Management Arrangements. So if you look at the apportionment of responsibilities, systems and controls, general organisation requirements, there is a lot of guidance in there of what FCA expect, taking reasonable care to maintain a clear and appropriate apportionment of significant responsibilities. So it's clear who is accountable, and that the business and affairs of the firm are being adequately monitored and controlled by the directors. So they said oversight, management information, and your governance arrangements need to be robust, and they include a clear organisational structure with well-defined, transparent and consistent lines of responsibility, effective processes to identify, manage, monitor and report the risks, and internal control mechanisms, including sound administrative and accounting processes. One can expand on that by looking at the FCA Principle 3, which is where a firm is obliged to take reasonable care to organise and control its affairs responsibly and effectively. Now, this is quite interesting because Ocorian is looking to become, and has been in the past, a skilled person for the regulator. So we have a little bit of insight from them around when they are looking to have a review of a firm's governance arrangements, what they want you to take into account. So obviously, appropriateness and effectiveness of governance arrangements, leadership and individual accountability, including, of course, compliance with the SMCR regime, so clear statements of responsibilities, including prescribed responsibilities and others, evidence of consideration around reasonable steps, linking those responsibilities to how they are actually evidenced in practice. How does a senior manager evidence that they have taken reasonable steps in order to fulfill those objectives? Effectiveness of governance in practice to provide oversight on delivery of outcomes. So they're very outcomes focused. So you can't pay lip service to the stuff, and FCA have, through the principal regime, a fantastic 2020 hindsight of if the outcome is poor, then something must have gone wrong. It's a sort of, prove a negative, if you like. Something's gone wrong. Your systems and controls have not been effective. It's interesting that we could just touch on organizational culture. And it's here that FCA talk about, interestingly, psychological safety, the diversity of thought, non-financial misconduct and inclusive culture. We know that that's something that they are concerned about and therefore expect boards to be concerned about and to seek information around the general conduct culture of the firm. There's an expectation that there are clear and effective whistleblowing processes and practices, people policies, which include remuneration, hiring, and competence, that those are effectively assessed, and again, that the board is comfortable with the firm's arrangements in terms of checking, not just at the point of entry, but on a refreshed annual basis around competence and fitness and propriety. And I think, as I say, culture is very difficult. How do you measure culture? And also, it's sort of easy to say we know what bad looks like. What does good look like? And that's a challenge that we sometimes talk to boards about, around what data, what empirical data can a board look at that gives them the sense that actually there is a good culture, and is it employee surveys, exit interviews? How do you get your hands around that? So I think FCA themselves are data-led, as they keep telling us. I think their expectation is that boards similarly are data-led. So it's not enough to assume we're all jolly good fellows here. Boards to be able to challenge the executive. So I think they expect boards to have effective challenge, and I think there's sort of the nervousness around groupthink, and as can happen in some asset managers, where you have a alpha character as the founder who brands themselves a particular way and doesn't allow contrary views, and that's obviously an area of concern. We've had a couple of cases, of course, from Mr. Odey, Mr. Woodford, examples where there wasn't sufficient challenge either within the boards, but also in some of the third parties that were acting in associate with those companies. So there's a lot of focus from the regulator on this point, and you as firms need to be able to answer the questions around how you have set out your governance arrangements and how effective they are. As indicated at the beginning, financial crime continues to be somewhat of an obsession for FCA. They came to the banks first, then they came to the asset managers. Now they're coming into the alternative asset space, largely because FCA say, look, we know that you've all got these wonderful laminated procedures, but we're still not sure you're really living them, especially when it comes to live transactions. So, what you say you do and what you actually do, we think there is a disconnect. So what are they talking about in terms of financial crime obligations? Clearly, as an absolute base level, sanctions, early sanction checking against investors, but also beneficial owners, directors of companies that you invest in. And as we know, whilst generally around financial crime, you can take a risk-based approach, you cannot take a risk-based approach when it comes to sanctions. Individuals or companies either are or they're not. And if they are, you may not do business with them. And be careful around pre-marketing, because arguably, if you provide any financial service to a sanctioned individual, which would include advising or arranging, you're already in breach. So if you have meetings before with investors before you've sanction checked them, you are at risk. If you start talking about their investment strategy, for example, you are at risk of providing a service. So I would definitely encourage early sanction checking. Then obviously there's money laundering, terrorist financing, and relatively new proliferation financing, a specific offence around prevention of being involved in companies that are providing financing for armaments. A word to the wise, the supply chain in that is an interesting phenomenon. So you might be investing in a transport company, but that transport company has a significant contract with a bad actor, a bad jurisdiction who is involved in the provision of armaments. So you need to consider that in your investment due diligence processes. Bribery and corruption, fraud, all of these things the FCA expect you to consider when you're making your investments and approaching your investors. And their expectation, as I indicated, certainly looking at this survey, is that you have a business-wide risk assessment across your products, jurisdictions, your distribution channels, and your different client types and investments that is specific to your business. So it's not a cookie cutter, and it's not, which I've seen, a leap of faith to say, we're low risk. I've seen this many times where firms conclude they are low risk without showing the workings, and that's a particular bête noire of FCA. They want you to go through the process of saying why you are low risk. Additionally to the business-wide risk assessment, there's an expectation that you do a client risk assessment on each and every investor and investment, which will then determine the level of due diligence that you should be doing. And there is a significant number of questions around how you monitor. What is your suspicious activity monitoring program? And there does seem to be an expectation that that has some degree of automation involved in it, not purely manual. Now, it may be that you would argue that that's disproportionate to the nature of your business if you have a small number of investors, a small number of investments, but you would need to prove that your manual monitoring was sufficient and adequate. So if you look at what FCA expect when they're assessing financial crime risk, both for investors and for investments. I'm actually going to start with sanctions because, as I indicated, if you fail that first hurdle, game over. So check for sanctions, and look at the legal entity type. Is it complex? Is there a good reason for it to be complex? There can be completely legitimate reasons, but there can also be illegitimate ones. Is it opaque? Is it embedded in some rather interesting sandy locations? Why is that? And that takes us then to geography. So there's two elements of geography. Where is the structure who is making the investment, or where is the structure that holds the investment that you're going to make? Where is that located? And then where is the actual business located? And they can be two very different things. You can have one in a low-risk country, the other in high-risk. You can have them both in high risk. So you could have a Jersey structure, but actually the flow of money is the actual money that structure is then using to make their investment comes from a high-risk geography that be on a FATF list, for example, and is associated with some of these other high risk factors. So you need to look at supply chains, as I mentioned. You need to look in the round at where is this legal entity? Is it part of a group? Has it got subsidiary operations? Are there reputational risks associated with those? What industry are they in? Is it a high-risk industry? When I talk about high-risk industry, obviously armaments is clear, but things like that are cash-rich industries, casinos, hotel and leisure sometimes, diamond trading, anything where there is a lot of cash floating around, gambling, for example. It's not to say, just to make the point, that you cannot take money from investors who have these involvements, or that you cannot make investments into such companies, but that you need to take these sensible steps to really understand the risks that you're taking on. And the other one is politically exposed person. So is the investor themselves a politically exposed person? Are they associated with one? Or is the structure that you're investing in, does it have directors or ultimate beneficial owners who are politically exposed persons? Because that will automatically mean that you should regard them as high risk, and you should be applying enhanced due diligence. So anticipating this next slide, so this investment or client risk assessment should lead you to three, well, it could lead you to four. It could lead you to say, this is so high risk, we're not going any further, and so we're going to decline. Or you could say, actually, this is lower risk. It is no longer possible just to go, it's that, therefore it's lower risk. You still need to go through the assessment, but the sort of factors one might take into consideration is the investor vehicle or the investment listed or regulated, located in a very positive financial crime country. And you can look at Transparency International, for example, that publishes lists of countries where they are in the POP charts when it comes to bribery and corruption. I think we're around number 23 last time I looked. The least corrupt place in the world apparently is Finland.
Okay.
Who knew? But it's part of the sort of whole business of don't just assume, get data on it. Have a risk appetite. So your board should be saying to your risk and compliance committee, what is to determine what the risk appetite is around investors and investments. We don't want higher risk investors or investment. What, none at all? Never? What are the circumstances? You allow some, or if you suddenly find that your entire investor base is higher risk, is that something that concerns you? You can say, you can have that appetite. But what you can't do is say, we have an appetite, our appetite is only for standard risk investors. And then when it comes to it, actually half your investors are higher risk and you didn't even know. And you hadn't done anything about it. The trend was going up and you didn't know as a board. Saying we didn't know is not going to cut it with FCA. So you need to have that. And obviously a number, in the case of funds, with investors, certainly, it's usually delegated to the fund administrator who does these checks and assessments. But the board, the manager, needs to still have that information. So again, I see the mistake that firms make is that they say, well, that's nothing to do with us. Our fund administrator does all that. Well, have you checked that the fund administrator is doing it well? And is the fund administrator following their own policies and procedures and providing you with sufficient data so that you have the requisite oversight over their work? It's not apocryphal because I was there. I was asked by one fund manager client whether he ought to do annual due diligence visit to their fund administration. I said, yes. He said, well, come with me because I don't know quite what to ask. And we walked into this room in Dublin, and There was no one there over 21, I'm not being ageist, but having talked to them for a while, and they were all lovely people. They were all resting actors. And they basically, their KPI was doing 10 checks an hour. So there was no quality, as far as I can see, there was no qualitative check, and they didn't have really any idea around escalation, etc. So I said that he needed to sack them or tell them to improve. So it isn't, doing due diligence on third parties is important. Okay, moving on then, what are the other risks that you should be taking into? Financial crime is a biggie from FCA's point of view, but there are others, of course. And some of these I'm going to sort of go through rather quickly because they are the stuff that investment professionals do as a matter of course. Of course, when looking at an investment, one looks at that investment's capital position, their liquidity, then looks at market risk. Can you value it? What is the valuation in the public domain? Probably not. How do I derive a good valuation? What sources do I use? What's the sort of volatility around this investment's cash flow or business model? And then there's sort of the macro geopolitical factors, including how they might affect their supply chains. I would expect the investment professionals in investment firms to be all over those. Where compliance departments and boards probably just need to poke them with a stick a little bit, some of these other risks. So operational risks. So within the investment itself, are there conflicts? So is there anybody in the investment manager got a cross directorship into this investment? Now, in some cases, I know that is actively pursued, and it's part of the investment strategy is you put a director on the board of your portfolio company in order to increase value. But there are conflicts between being a director of a company and being a shareholder sometimes, and they need to be thought about and managed effectively. Are there operational resilience issues? We know in Europe, certainly through DORA, and in the UK with some of the larger firms, but inevitably it will come down to the smaller firms, there's a lot of interest in operational resilience and reliance on the provision of IT services. And are there key person risks within the investment and more other human resource dependencies? I think it's important that FCA have talked about this, that there are some more so-called esoteric risks that firms need to take into consideration, as well as ESG. Simon and I were talking before now, saying that ESG seems to be taking a bit of a back seat at the moment, largely because it seems to have become a dirty word in the States. They don't use ESG anymore as a term, but also sadly because quite a lot of ESG funds haven't necessarily performed as well as they might. Notwithstanding that, if you are using any kind of label, or if you're an Article 8 or Article 9 firm in terms of the European SFDR, you have to comply with what it says, you do what it says on the tin. And also in terms of the environment risk and social and governance risk, there is the mislabeling. So if you are not pursuing objectives linked to those things, and yet you say you are, you've labelled accordingly, or you've given communications to your investors that imply that you do care about those things, and yet they are not really part of your investment process. That's one thing. And then there's the impact risk. So is this, if something goes horribly wrong at the portfolio company level, is there a climate risk, a real life climate risk challenge? Are they going to have an oil spillage? Is there going to be a scandal around the fact that they're paying their CEO 300 times the amount that they pay the next employee, that they don't respect diversity and inclusion, etc.? But going back to these other esoteric risks, are there required licenses that the business need to have in order to be successful, and have these been applied for, and what if they're withdrawn? How will you monitor that? And are there science and technology dependencies? A piece of science has to work, or technology has to work again, including the use of AI. How does that play out? And have you got the requisite competence and understanding of those risks to really form a judgment? I go back to my fun specialist subject of anaerobic digestion, which I never thought I would have to know about, but I sadly do. There was a whole stuff going on for years around infrastructure funds that invested in anaerobic digestion, and the boards didn't necessarily understand the sort of science behind how it would work in order to actually be effective. And there was stuff about wheat versus oats, which I won't even go into. I sat in on a board meeting of a company who shall be nameless, where the board were all scratching their heads and saying, why is this investment so sort of just not making any money? What's going on? And I was able to tell them a little bit about anaerobic digestion and the challenges. And they said, how do you know this? And I said, well, listen to the Archers. I actually knew because Brian Aldridge had an anaerobic digestion. That put me in a place of greater knowledge than the rest of the board, which obviously wasn't great. So you do have to understand that if you're taking on risk, that you've got the requisite knowledge and competence to really understand it and measure it, because if you can't measure a risk, you can't manage it. So your investment committee, leading on from that, and bearing in mind your investment committee reports into your board, you need to think about the composition of that, who has got votes and who hasn't. There clearly needs to be portfolio managers sitting on it. It would be absurd not to. That's what they do. But getting the balance right of them versus independent members, is there clear terms of reference? Have you got the requisite challenge and expertise? Do you need specialist inputs? Do you need a scientist? Do you need external co-optees, NEDs, for example? How often should it meet? There should be a sort of standing agenda, and then are there triggers? Are there triggers within your investment portfolio that means actually we should go back to the investment committee because the risks have morphed, increased, what have you? Documentation. I can't tell you how much, if FCA live and breathe by if it isn't written down, it didn't happen. So it's really important to minute these things with, as I say, tracked action lists, key risk indicators, metrics, clarity around where the second line of defence comes in terms of investment risk. I think it's more around making sure that the controls are in place and that the processes work. How the investment committee should escalate where risks become intolerable, and how the board should oversee this. And really importantly, in the investment committee, you need to discuss conflicts, which is a wonderful kind of segue into my next topic. And as I mentioned, FCA have said it's one of the greatest risks that they perceive in the asset management sector is not managing conflicts effectively. Now, there's some really easy ones that everyone tends to know about and get right, which is around sort of individuals, so having personal account dealing policies, procedures, having a gifts and entertainment register, although, as we know, H2O failed to do that, recording effectively outside business interests, understanding, connected persons, spouses, relatives who may have interests which could represent a conflict. And then there's the conflict where someone is wearing multi-hats. So where in some of the smaller firms, inevitably someone is both a director, an SMF3 executive director, but also possibly an SMF 16 and 17. And we know that FCA kick against that. As we see in more recent authorizations, they're getting less and less comfortable about combining those roles of executive and control functions. So where you do, you need to have an answer to the question, well, then how do you manage the conflict of that? And there are various ways you could do it, whether it's use of a NED, external consultant, etc. But then also there are, of course, the less common conflicts. And here's where FCA seem to be concentrating their efforts at the moment. They kind of know that people have got the simple, the vanilla ones right, but they're asking questions, and there is a multi-firm conflicts questionnaire going round. Few clients have got it, where they're asking proactively again, what are your arrangements? And you kind of get the feeling that if you haven't got very good arrangements, that you'll get a visit. So they are asking about how you manage, where you're running different strategies. So you're potentially running an equity fund and a credit fund or a debt fund, how those interact, where there are overlapping investments. How do you manage allocation between funds, and what about carry vehicles? And how does that interact then with, if you're running segregated mandates as well across the same strategy, how do you allocate? And inevitably, what's the remuneration to the firm, the consequences to the firm from a remuneration point of view? So is there any incentive to cherry pick for one fund over another? Also in terms of the individual remuneration, is an individual incentivized to emphasize the benefit of one client over another? And we've seen there's been stuff in the press about a fund manager a few years ago now, where they had an internal fund which they ran for the benefit of their staff, and an external fund. And it was their strategy was to select fund managers, and they selected the highest performing managers for their internal fund and the lower ones for the external fund. Guess what? FCA didn't like that at all. And you've also got to think about multi services within the group. Using a group service provider, are they the best in class? Are they the right person to use? Have you gone through a due diligence process, notwithstanding that they're a group company? And then there was a private asset valuation review conducted earlier this year by FCA, and they raised issues that they wanted client firms to think about around, are your fees linked to stale valuations? So you've got a performance fee, you've got a valuation. It behoves you to keep that valuation high, notwithstanding that actually you might need to revisit. Looking at asset transfers between funds in private equity and ensuring that they are done at a fair price. Looking at redemptions and subscriptions during liquidity stress events, around conflicts around that. And also investor communication, sort of between valuation periods. What do you say? And sometimes we can see a disconnect between what the valuation department are doing and what investor relations are doing. Investor relations are all saying it's all marvellous, still marvellous. And then investors saying, well, hang on a minute, when did you know that actually the valuation needed to take a significant downtick, and you didn't tell me? And then this whole question of what regularity of valuation is appropriate for private investments, and is it the same, regardless of what kind, if it's art or wine, is it different from real estate, which is it different from an infrastructure project? And I think FCA is sort of saying, we feel like quarterly is right, but we're not quite sure. Tell us why that's not right. But they are importantly saying, and are there defined trigger events where you would go back? I mean, obviously COVID was a classic example where if you just sort of sat on a hotels and leisure investment and didn't look at it throughout COVID, that would be somewhat disingenuous, shall we say. So conflicts management, what is the FCA expecting it of you? And again, just to tie this back to where we sort of started, You could have a conflicts committee, you could have compliance involved, but ultimately all of this needs to be owned by the board. The board needs to be able to speak to this very cogently. So obviously, as with everything, you need a sort of a risk-based approach. So you focus on outcomes. So where is the most negative outcome going to occur? So do you particularly care that sort of Steve in accounts happens also to be a director of the building he lives in? Not really terribly important. Probably worth recording, worth discussing on a regular basis? No. But so focus in on the ones where harm could occur. Think about, balancing, risk management versus practicality. If something is just, becomes an admin task rather than a risk task, it loses value and impact. It is really important to sort of keep conflicts under regular review. The conflicts register shouldn't be a sort of dusty document. It should be dynamic and, records kept up to date. When was this conflict last looked at? What was the conclusion around why it was acceptable, and what were the steps being taken to manage that conflict? Are they still valid? Has something changed in the interim? So as I say, it's a live document, not a static one. And you need to have sort of preventative control. So you've got a policy, you need to tell us, you need to do this, you need to do that. But you also need to think about detective controls, so sort of procedural controls where you look back at transactions or minutes and go, hang on a minute, that should have been declared. So you need to have a sort of second line of defense review of how conflicts roll out in practice, and that independent review and challenge. And I think my final point, and I'm sorry, I'm sort of going slightly over time, not allowing enough for Q&A, but this is my last point. Don't forget that there are different types of conflict. Actual are probably the easiest because they're there. You can see them, and you can take steps to either avoid them, cease and desist doing something, or take very clear, definite steps. Much more difficult are potential conflicts yet to come. The way that this could arise, and what would we do in that circumstances? And those are the ones you really need to sort of keep an eye on. And also, of course, and sometimes the most difficult of the lot, are perceived and alleged conflicts. So where an individual themselves go, this isn't a conflict. This is not going to play any part in my decision making. Dare I suggest that Sir Keir Starmer didn't see how things would play out in the press around his receipt of spectacles, I think, and clothing. He clearly thought, I am a man of integrity. This is going to make absolutely no impact on my decision making at all. But that's not what the court of public opinion said. So one needs to think about that as well. Right, I've gone over inevitably, but Q&A is where we're at now. Simon, do you want to sort of, did you want to lead that?
Yeah, well, it'd be wonderful if anybody out there would like to ask any questions. Please put your questions in the Q&A box, and we'd like to work with them. Firstly, Abi, from my perspective, thank you so much for that really informative walk through all of these topics. If I have one regret, that we're not all in a room actually having a coffee or breakfast and kind of there to give you feedback just on how wonderful that was and to ask you questions. Just as we're waiting if anybody else wants to ask anything, I have questions myself. I mean, I've taken from that data is everything, documentation is everything. Actually, listening to the archers is probably quite a good idea sometimes too. So that's quite a good practical tip there. But it's an awful lot for principals, business owners, executives to manage. As we know, we have a market in London where we've got some very large firms, but we've also got an awful lot of firms that, for want of a better word, are SMEs.
Yeah.
How well do you think boards and investment committees are doing at the moment in challenging oversight and making sure that they are getting all these different policies and procedures documented?
It's an interesting one, and I mean, I could give the slightly glib answer is that the ones that have had an issue and have come under the FCA spotlight have got a lot better in a very short time frame because they've recognised that they need to do it. I suspect there's still quite a few that are flying under the radar. And, you know, I get it. Of course I do. If you're an investment professional, the most important thing for you and your investors, to be honest, is that you make good investment decisions. And all this other stuff just feels like so much noise. And that's true until it goes wrong.
Yeah.
And I kind of tease some of the investment professionals that I talk to and say, look, you are a born optimist. That's the nature of your job. Said, my nature of my job is to be a born pessimist, because I'm always thinking, what if it all goes horribly wrong? And that, as I say, that wonderful 2020 hindsight that FCA have against those principles of like, well, it's all gone horribly wrong, so you must have done something wrong. Yeah, and being able to sort of stand to them and say, no, actually, sometimes, you know, bad things happen to good people, and we did everything within our power. We took all reasonable steps. We had good policies and procedures. We hired the right people. We checked that they were competent. We made sure that they had integrity. We made sure that we had the requisite policies and procedures in place, and that our staff understood them. They weren't just sort of lip service, that there was proper engaging training that was bespoke to the company. We met, we discussed these things in a live environment. Look, we wrote them down here, and we took action, and we escalated, and we did all of that. And actually, this investment went to zero. What should happen is FCA say, okay, it happens. It's, you know, firms can't guarantee their investments, but what they can do is guard against FCA saying that they've made poor choices through poor process.
Yeah, absolutely. And I think, you know, your initial point around it is a performance-based industry, but it is a risk industry now, isn't it? It's a governance and risk industry just as much as a performance-based industry. I think it's fair to say. And
I think it's all about managing risk and having known risk and managing it appropriately. I mean, if someone says to me, "Oh, we have zero tolerance for risk," or he's like, "Well, that's go home and unplug your phone. You shouldn't be in business." You have risk taking is inherent to what we do, including an element of compliance risk. But it's just about managing it sensibly and effectively.
Can I ask you two more questions? I think others aren't going to ask, but I've got two questions I want to know. What practical signs can boards look out for whether their governance framework is genuinely effective and not just documented?
I think it's. I would employee surveys but probably in-person interaction with employees, walk the old-fashioned walk the floor.
And the exit interviews you talked about earlier as well. I think you don't see that.
I think that's important. There's no substitute for actually sort of taking the temperature of the room.
No.
And not just be told, oh yeah, by the senior management, oh yes, it's all, everything in the garden's lovely. I would dig a little bit further. If the turnover of staff is very high, you've got to ask why that might be. The number of instances of complaints, whistleblowing, employee legal action, what have you, that also could give you a clue that something's not quite right.
Yeah, absolutely. And then one final question. If there's one area of governance you think so there's an awful lot going on here, there's an awful lot for people to cover and time is limited. If there's one area of governance you think boards should prioritise over the next 12 months, what would it be and why?
I think it would be that I am absolutely comfortable that my firm is all over financial crime risk in respect of our investors and investments.
Yeah, okay, that's perfect. Well, we're going to wrap it up now. Abi, I'm sure that you're happy for people to reach out to you.
Of course.
Your contact details are on the Ocorian website, and naturally everybody can get them from us here at Fram. We will be sending out this recording, but thank you so much for a really informative session. I hope people enjoyed it. And I hope you enjoy the rest of your day.
Thanks, Simon.
Bye.